Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update, shall we? I'm going to start with the usual on-chain metrics here. We'll start with Bitcoin, migrate over to Ethereum. I'll talk about Celsius a little bit from my understanding as far as what's going on here. And then we'll talk about technicals. So on-chain wise, you would have no idea that price is declining as quickly as it has been because you're continuing to see on-chain activity. Now, is it rising on-chain activity? No, it hasn't been really for quite some time for Bitcoin or Ethereum. And that's a hint that we're starting to see a slowing here in general, right? What we haven't seen yet, or perhaps won't see, is a falling off completely of on-chain activity. And again, I say this every video, but it's important to understand this isn't necessarily even the complete picture of Bitcoin specifically, because when we talk about Bitcoin versus Lightning Network or Ethereum versus other scaling solutions, not all of the metrics capture all of the transactions. You also have to know that you can send multiple transactions at the same time. This is referred to as batching. So that is also not baked into this data either. Nevertheless, transactions flat, just sort of taking a temperature check here. What we did see this week, we didn't see a massive rise in on-chain activity. We did see volumes pick up on exchanges, and we did see the mempool, which is the transactions waiting in the queue to be confirmed, which is what these orange lines are showing here. We did see the mempool get very active. So that means there were a lot of people moving coins around during the down periods. And as with anything, as price goes up or down, two extremes, you do see an increase in emotional human activity, which you can actually measure as on-chain activity, right? So we saw a ton of activity picking up on-chain. This was yesterday. Sorry, this was last month. This was yesterday. Again, any of these down periods, you tend to see a lot of on-chain activity in the micro near term when that happens. Active addresses falling off a bit here, still well within a range. You're not seeing week over week, month over month increases in activity here as you had been, in the 2014 to 2017 era. And we've yet to see on-chain activity declining in a massive way just yet. We can look at hash rate as well, which talks to on-chain activity in a way, because if there are more miners on the chain, there's more transactional activity on the chain just from the mining perspective. And again, when you're looking at transactional data, you have to really know what are the possibilities here other than peer-to-peer transactions, right? Miners are definitely a big one if it's proof of work. And hash rate has continued to increase, really. I mean, depending on how you want to look at this on a weekly basis, on a monthly basis. On a weekly basis, on average, it's at an all-time high. Monthly basis, all-time high. This will come down because price is going down. And as price goes down, profitability typically goes down. So this is going to adjust over time. You can see how noisy it is on the hourly. It's also, again, an imperfect metric. It's sort of a fuzzy estimation. It's not perfect. The better mining metric that fewer people discuss is difficulty, because that is locked in every so many blocks, 2016 blocks, where difficulty locks in and decides how difficult the algorithm is to solve for proof of work. Difficulty also sitting near all-time highs, and you can see again how difficulty has either risen in bullish periods, fallen a little bit in bearish periods, but it, in a literal sense, is how difficult it is to solve that algorithm. So if difficulty is rising, miners are usually less profitable if they have the same amount of hash rate. Typically, if the network difficulty is rising, hash rate is rising at the same time. And if you're a miner, hopefully you are keeping that profitability level by adding more hash rate, right? As people remove hash rate for various reasons, difficulty comes off, and those miners that can maintain their computational power, in effect, gain profitability against difficulty. They don't gain profitability maybe against price, right? Because price is declining, but this gives you an idea of all of the variables and complexities here. Obviously, overhead, electricity, the network itself, all this is determining that profitability metric. The efficiency of the machines being used, the ASICs, right? This is all part of that equation. So I do expect difficulty to come down a bit with hash rate, with price. I expect all that stuff to come off over time, most likely. The one reason why it wouldn't decline is if you're a miner and your profitability level is below 20,000, let's say it's 15,000, you're going to keep that hash rate on because you're still turning a profit, right? Let's say it's above 20, your break-even level, and for operational reasons, right, you can't afford to maintain that electricity cost or whatever. This is, again, super complex. It's not as easy as here's the break-even level, these miners shut off. Some people just mine knowing that they're not profitable based on electricity for X period of time. So it's hard, as much as people want to just lump all the miners into one category and say this is the average break-even level. Electricity at 4 cents per kilowatt hour is affordable on this miner, right? You can't really do that. It's not that easy. And it's getting more and more complex every day. Miners' net position change. This is how much miners are holding coin-wise, because we can see this coin was minted at this exact time in this exact block. Where does it go from there? Does it sit in the miner wallet or does it move somewhere else? Typically, if miners are moving coins, they are selling, not always, right? Sometimes they might be aggregating coins or whatever. Pools change where coins sit for various reasons, wallets moving around. Imperfect, but also gives you a general sense of what's going on. So depending on how this is measured, you can see, okay, are miners selling here or are they holding here? And it looks like we had a lot of selling based on the miner net position from like April just until a few days ago. And miners have began to hold again, at least in the near term. And the general idea for this potentially is as we go lower, certain miners are forced to sell to cover operational expenses, right? And those miners that are profitable or maintain profitability at certain price levels don't feel compelled to sell for whatever reason and can continue on, right, at a lower profitability level. That's one way to read this. From a price perspective, obviously, if the miners are selling into weakness, into price weakness, price tends to go lower. You know, that's not a secret. But ideally, what you want to see is miners selling into strength, which is what happened in early 2021. And historically, you know, we can look back and say 2016, 2017, right? Most of this was selling, even at the very top, right? There were tons and tons of selling, arguably. You know, again, this isn't perfect, but let's assume it's selling, and how that sort of shifted pre 2021 bull market in that picture was very different. It was net holding, right? These are miners that were just maintaining profitability, maybe even treading water, but they weren't compelled to sell or move coins around. Another way we can look at this data is the Puell multiple, which is a measure of the notional value of how much miners are making today versus the average in the past year, and look at this on an oscillator and see if there's any correlations. And there are, which is why I'm talking about it. So as this multiple is extremely high or has been high in the past, we tend to see market tops in price, and the opposite is true for the inverse, and very much related to realized profits or unrealized profits. If miners are making a significant amount, it eventually becomes unsustainable. And eventually, as miners are selling into the market, right, the market can only absorb so much, it hits an equilibrium, and price tends to go in the opposite direction. So another way to think of this is how stressed are the miners today versus a year from now? Are they making bank, right? Or are they on sort of below the average expectation for the prior year in a notional sense? So we are approaching now levels of what you could call like miner distress, with that multiple being below 1, meaning miners are making less today than they were, right, over the past 365 days. We can also look at the Z-score, which is very similar, the MVRV, which is very similar to Puell, at least how it looks. This is a measure of market cap versus the market cap of coins that have last moved on chain on average. So again, if we're thinking about realized price, unrealized price, and we look at the realized cost or the realized price as an average aggregate value, historically, if we start to float below the realized price, you know, if we get underwater on that realized price, typically we're there for an extended period of time, and typically that has been the bottom. No guarantee, obviously, but we are approaching those levels of being below the realized price. And really the elephant or the gorilla in the room has been Bitcoin has done extremely well in a falling rate environment historically. And now we're entering a period of rising rates. And can we sustain these metrics during this period of rising rates? Ethereum, much the same. Transactions falling off a little bit. I mean, you're still seeing robust DeFi activity, nothing close to what it was at the peak, but it's still significant. You're still seeing NFT activity, nothing close to the peak, but there is still activity on chain, most certainly for Ethereum. And it looks like it's just below 1 million addresses, 1 million transactions per day. Active addresses falling off a little bit too, down to around 400,000 to 500,000 active addresses per day. So in general, activity is still there. It's muted. Hash rate, again, on Ethereum, still basically at all-time highs, even with price where it is, even with transaction fees coming down, even with the merge from proof of work to proof of stake coming, hash rate's still very high on Ethereum. Looking at Ethereum's MVRV, again, we are well below par with market cap versus on-chain activity or realized price. We are seeing a market cap far below realized price here for Ethereum, which is where it has lived previously. So this isn't unprecedented, certainly, but the issue, the grand issue with all of this is the metrics I'm seeing, technicals on-chain analysis, are telling you maybe this is the bottom here, right? Maybe it's going to take some time, but maybe this is the bottom. The fundamentals, the macro side of things are telling me we're nowhere close to a bottom. That's the general read on things. So, what's going to win at the end of the day if rates are rising and on-chain metrics are saying historically this has been a good time to DCA or to think about entering, right? And we have corporate layoffs, we have recession talks, right? It's nothing good ahead of us in a macro sense from my perspective. So what's going to take over here? Can all these metrics be wrong? Of course they can. So it's going to be an interesting time to see what holds up and what does not. Flipping gears to talk about Celsius real quick. For those who don't know, Celsius is a crypto lender. They take user funds, go out with those funds and get a yield, and then they promise the user a yield in their app. That's my understanding of it generally, right? And one of the things they did potentially based on on-chain evidence is they entered stuff like staked ETH. So you take your ETH, you stake it for ETH 2.0. It's locked up for a specific period of time, dependent on when the merge happens from proof of work to proof of stake. And then you can swap that out and you can get additional yield in the DeFi ecosystem. So it was called a liquid staking derivative because previously the stake was not liquid. So you're making it liquid, you're putting it to work, you're sort of getting yield on top of yield. And Curve was one of those places where you could swap in between pretty freely. It wasn't a peg, but it was a one-to-one, right? Effectively, it is a one-to-one with a lockup or investing component to it, because eventually this will unlock. Eventually this staked ETH will just be ETH. But as you can see here, the exchange rate is far below 1. And not only that, but the reserves, so your ability to transfer this staked ETH back into ETH had been dwindling. So what likely happened for Celsius, this may be one of their wallets based on on-chain evidence, right? I don't want to get too specific in saying this is definitely them, and they definitely have this amount of staked ETH, but they have a lot of staked ETH. And if their plan was to use Curve to handle withdrawals for ETH, and they no longer can do that, or they can do that at a significant loss, then they're in trouble. And I think that's partly what happened here. Now they can use OTC means to right the ship, certainly, and that may be what they're doing by halting withdrawals. This isn't a GOX situation. This isn't a 100% loss hack, but I also don't think they are 100% one-to-one on reserves. They may be running some sort of fractional reserve situation here. So I don't want to get too specific because I don't think anybody exactly knows. They just assume the worst here. But based on on-chain evidence, based on their wallets, it's very likely that this is them and this is what they're working with. One other issue for Celsius is they have a very large loan through MakerDAO in wrapped BTC, and this could get liquidated should price go below that liquidation price. So one of the DeFi arms is lending and borrowing. One way you can do that is use collateral, in this case through MakerDAO, to take out a loan. And again, this is about yield and generating yield. And in a bullish environment, this works beautifully. In a bearish environment, this tends to get more difficult to manage because everything is generally correlated in crypto, and you need to add additional collateral on the way down, more and more and more. eventually you may run out of collateral and then price goes against you anyway and you get liquidated and you lose it all, right? That would be a margin call. So this is another concern because this represents a significant amount of BTC for them, right? As well as just generally for price. So a lot of people are watching this as well. Switching gears to technicals, talking about TradFi for 2 seconds. DXY, which is a measure of US dollar versus the world, sort of in a basket index, mostly against the euro, continues to push higher. The correlations for crypto historically have been crypto has done best when the DXY is declining. So it would behoove us market-wide to not see this continue in its parabolic rise. Something to watch on a technical basis is if it truly hits escape velocity out of this multi-year range, then that may represent additional downside for crypto. Something else to watch is the VIX, the volatility index, the fear index. If the VIX keeps creeping up, it's amazing to me that it lives at 25 plus now. Historically, it's lived at sub 20. COVID was an exception. 2008 was an exception. There it was plus 50, plus 80. So it just continues to creep up. This continues to just represent uncertainty, fear. This needs to settle down before I think crypto turns the corner. So that again is just something to watch on a correlation basis. S&P as well, just looking at the technicals, potentially it could retrace 50% of the COVID low to recent all-time high, right? That's just basic Dow theory when we're looking at ranges. Some people are calling lower than that, but I think it's a good level to watch on a technical basis. Something else to watch is how long we bounce around in this pretty aggressive downward channel. And the NASDAQ is already below that 50% level. Not saying it's oversold, not saying it can't go lower. But again, these are levels people are certainly watching. You can always add an additional Fibonacci level, the 0.618 from a technical perspective, which would be around 10.5, something like that for NASDAQ. But again, you have this aggressive kind of downward megaphone that is eventually hard to maintain because you do tend to see exhaustion for any type of trend up or down, right? Again, I'm not saying this is the bottom. I'm not saying macro looks horrendous. I'm not saying Powell won't raise rates 75. Even I've seen 100 basis points. So we'll see what happens, but it certainly is more and more difficult to maintain that kind of aggressive trend without some sort of relief. And the reason it's important to watch this stuff is because it is correlative to crypto, especially in the US markets. BTC on the technical levels, if we look at it kind of naked and we just look at super high time frame stuff and we say, what does RSI tell us here? What is an oscillator telling us? This goes back to the MVRV conversation. Historically, it has been a good place to think about a DCA type of situation, or is this the bottom, right? And everybody wants to know how ugly can this get? Historically, this is about as ugly as it's gotten. You can see COVID, 200-week moving average. We dipped below that for 2 weeks and then eventually came out of that. The problem now, again, can the technicals hold up with macro fundamentals, what they are? This is an all-time low for weekly RSI. If I was on a deserted island in a vacuum, I'd say, okay, weekly RSI is at an all-time low. We're at the 200-week moving average. It looks like we're good to go. If I'm looking for additional downside based on levels, I'm looking at things like the 12K level, which was historically sort of a ceiling here. I'm looking at 20K, which is the previous all-time high, and potentially even that range from 12 to 20. And like you'll see on ETH, there isn't a lot of technical evidence for support or resist levels in this range. We basically went week over week, kind of straight up from sub 10 to 50 plus, right? So we're going to need some time to build some levels there. The 2-year MA multiplier is also telling you again on a oscillator type of basis that historically this is a DCA spot. There's no other way to really say that because we're in a level below the 2-year moving average that has held up. But again, this is a different environment. This is a different situation where we're seeing rising rates rapidly. We're seeing inflation. We're seeing all sorts of issues on the macro side of things that may break certain expectations here that weren't otherwise broken previously. You can look at a hawkish Fed versus a dovish and how that lines up with this. And so long as things remain extremely hawkish, it's hard to see price calm down. So keep that in mind, obviously. Something else a lot of people are watching are the longs. So if we're looking at open interest, there's longs, there's shorts. There's a mega imbalance in long shorts on Bitfinex right now. This could be a hedge. This could be a lot of things. A lot of people are watching this. It'll be interesting to see how much more gets added to this if we go lower, how much of this comes off if we go higher. But it's definitely something people are watching. Flipping gears to ETH quickly. ETH has broken below its 2018 all-time high. It's broken below its yearly pivot. It's broken below the 200-week moving average, which is what this green line represents here. And it's also reached its TA target for this downward triangle based on Fibonacci extensions. Okay, so if we're looking for levels where we expect something to happen based on TA for ETH, these are the levels, right? It's kind of a make or break situation in the near term. The classic, the next week is critical. But I could very easily seeing us attempt a bottom here if Celsius gets their stuff together, gets their books in order. There's some fear removed from the market, at least on the crypto side of things. Then things might calm down a little bit on the ETH side of things. Not only Celsius, but there are other funds that are having trouble meeting margin requirements that are also likely a participant in the forced selling waterfall cascade that was ETH over the past week, right? Not something you normally see unless forced selling is involved. On the flip side of that, if we're looking for levels on the downside, again, like BTC, there aren't a lot of horizontal support resist levels, let's say, that you can really point to, because ETH very quickly went from essentially 400 to 4,000, held that range from 2,000 to 4,000, and is now trying to figure out, are there buyers down here? Can this turn around? So ETH has the merge coming up. For a lot of people, that's a big catalyst for them. But that remains to be seen if, again, can crypto fundamentals and technicals hold up against a macro disaster that's going on right now? I think ultimately, no matter how you feel about crypto, whether you've been here since pre-ICO days, been here since 2012, right? You have to be realistic about price and understand the forces here. Now, to be clear, the networks themselves are at no risk of collapse. Bitcoin has withstood much worse and will withstand much worse. It's fine. ETH is fine. It's the price and the participants here that are certainly playing a big role in what's going on. It's not a crisis of confidence in the network itself. Lastly, I'll just mention ETH BTC. It's also nearing the 200 week. That has come off significantly. This, again, probably related to Celsius and or forced selling, which is why BTC held up slightly better against ETH, most likely. In times of bearishness, you do see alts, including ETH, lose ground against BTC historically. That's how the correlations have worked. So this makes sense. TA-wise, this had set up for a nice ascending triangle, potentially, but that's long since passed here. And we'll now need to find a new home in this range, probably anywhere between 03 and 06. A lot of people watch this cross as a stamp of approval for ETH or for BTC, one way or the other. So it's pretty actively traded in the crypto world. So let me know what you think about this week with the US CPI print. That's really driving all of this. That's really drove Celsius probably going from illiquid to potentially not being able to meet obligations quick enough to having them halt withdrawals, right? This is all just a negative feedback loop, and it dates back even when Luna Terra exploded. So far, we've continued to feed the bearishness without exhaustion and without accumulation or a base. These things take tons of time to happen. So that's all for this one. Like, dislike, comment, share, subscribe, and happy trading.